Here we go. Yes. So hi everyone. I'm Dan, senior investment consultant at Quantum, and for the market update today, I'll be starting off by going through some of the key macro and market takeaways from Q3 and beyond. And throughout that, I'm going to drop in a few bits of outlook. So in particular, focusing on those big calendar events we have in politics. So that's the US election and the UK budget. And lastly, hopefully I'll have some time for this, but I'd like to just talk a little bit about considerations for investors in the current environment. So starting off with the macro background. So I've got two. You've got CPI, the experience of CPI we've had over the last few years, and the central bank policy rates. Now, Q3 was really the quarter that central banks started to feel quite a bit more confident that they got inflation under control. That's probably best illustrated by UK CPI coming in at 1.7% last week for September. That's the first time in over 3 years that it's been below the Bank of England's 2% target. So naturally, investors have been turning their attention to interest rate cuts, when they're going to happen and how deep the interest rate cutting cycle is going to be. Now, Q3 was the quarter when both the Bank of England and the Fed made their first moves, with the ECB moving slightly earlier. So for the Bank of England, in August, there was an initial cut of 25 basis points. Pretty standard stuff there. There's further expectation from markets that there'll be another 1 or 2 cuts this year. It was less of a clear picture in the US. So initially, early in the summer, the Fed decided against cutting rates. But actually, there were some numbers coming through in July's payrolls report, which jobs being created by the US economy came in well below expectations. This triggered some worries in markets that there was going to be, that the US was actually about to go into recession. So there's quite a bit of market volatility around this. And actually it then led the Fed to make a bumper 50 basis points cut in September. That's the kind of cut that's usually reserved for times of crisis, although actually the communication around it was quite well managed by the Fed, focusing really on the fact that they feel they brought inflation under control. Then actually August payroll came through in September. That actually overshot expectations, and now worries are more around overheating of the US economy rather than recession. So markets have downgraded their expectations for rate cuts, and we're now potentially not expecting any further rate cuts from the Fed this year. What that highlights, I think, to me is that central banks are reliant on a range of quite backwards-looking and lagging economic indicators to make their policy, and those can be quite volatile. So you can expect a bit more volatility to come, I think, in this interest rate cutting cycle. But the good news is that it does appear that central banks are doing a pretty good job of managing the balance between making sure inflation doesn't come back and keeping the economy ticking over. And we're not currently expecting any recessions in the UK or the US. So yeah, we have this environment of sustained economic growth, interest rate cuts, and receding inflation. So this has been manna from heaven, really, for equity markets. And the chart here on the right-hand side shows 12-month regional equity returns to the 30th of September. And it has been quite an amazing period, actually. So double-digit returns across the board for each region. The US is leading the way there on 36% for the 12 months. So this is pretty good time to be an equity investor. Looking at Q3, so the US again leading the way in developed markets on 6% for the quarter. This does cover up a bit of market volatility, as I mentioned, around the fears of recession earlier in the quarter. And actually there's been a bit of a rotation in the US away from the growth-focused tech stocks, which have led the way in recent years, towards the more defensive sectors. So we actually saw sectors such as consumer staples, healthcare, and real estate leading the way in the US. Now, more defensive sectors leading the way, that's usually pretty good news for the UK. It's more defensively biased. And the UK did okay for the quarter, 2.3% return. It's not too shabby. The reason it's lagged the US primarily is two things. So you have the energy sector has been a bit of a drag. So demand for energy has receded a bit on global slowdown fears. So the energy sector performed pretty poorly in the quarter. And the UK index is still weighted quite heavily towards that. The other thing is that sterling strengthened over the quarter, and for multinationals domiciled in the UK, that places it kind of devalues overseas earnings, so it's a drag on performance for these companies. The other standout from the quarter, I'm going to look at the emerging markets. So they led the way on double-digit returns. So in emerging markets, we see actually returns in these economies tend to be inversely correlated with US interest rates. So falling interest rates means lower borrowing costs in dollar terms, which a lot of these companies will be taking advantage of. It also directs flows towards emerging markets. The other thing going on there is that China announced a range of stimulus measures to try and jumpstart their economy, which has been stagnating for the past few years. And that had a really big impact on the equity market in China. Sorry, just have a drink. Now, it was a pretty strong set of returns for the 12-month period, as I mentioned. But I also mentioned there has been some volatility as well. It's not been a smooth ride. And this chart here is looking at the S&P 500 experience for 2024 to date. And you can see it's rebased at 100 on the left at the end of 2023. Return for the year so far has been above 20%, so really strong. But there have been these periods of quite significant drawdowns. And the one to focus on really is this 8.5% fall around the end of July, early August. So here, this was driven by those recession fears that I mentioned. And the sell-off was led by the big tech companies, which have been driving returns for so long now. The companies with the biggest investments in AI, they have been, they sold off the most on fears that they wouldn't be able to monetize the massive investments that they've been making in AI. So that's saw NVIDIA, Microsoft, and Alphabet, the parent company of Google. They all sold off by between 15 and 20%. And they have recovered somewhat now. Certainly NVIDIA is now back trading at record highs, but it does illustrate the impact that these stocks can have on the market. And we've been talking for a while now about concentration risk, and that's a theme I expect we'll be returning to in the next coming months and years. So thinking about things that could potentially upset the narrative for equity markets, I should have said that markets do seem to be pricing in quite an optimistic scenario with falling interest rates, falling inflation, sustained economic growth. So we're looking for things that could potentially upset that. And from the previous chart, it shows that when that narrative does change, markets can respond quite strongly. And the US election is probably the obvious one that we have immediately coming up. So as you're probably aware, the polls in the US election are too close to call. They may be wrong, but what this means for investors is that no one's making a particularly strong call on which way it's going to go. And it's difficult to kind of revalue your holdings. So we've not seen any big market moves, and this might partly explain why there doesn't seem to be any kind of let up in markets at the moment. Now, looking at the two agendas for the main candidates, or for the two candidates, so Trump's leading on tariffs. So he's talking about bringing in 10% tariffs on imports from the rest of the world, with 60% tariffs, particularly for China. That's a measure to protect American industry. He's also very strong on immigration control and bringing in tax cuts. And taken together, these measures are generally seen as being potentially inflationary. So obviously, tariffs will drive up the price of imports. Tax cuts will give more spending to consumers, spending power to consumers, and immigration control will drive up wage growth. There's also a school of thought that says that the tariffs will actually have a negative effect on the US economy. So taken together, the measures could be stagflationary, which could be quite serious. I have some figures as well from JP Morgan. So taken together, the measures are likely to widen the budget deficit for the US. And they estimate that over a 10-year period, it's likely to add about $3.7 trillion to the US debt. So for context, that's about 12-13% of current GDP in the US, and that's on top of their current deficit, which is running at 6%. So pretty substantial increase in debt. The Harris agenda, as you might expect, is a little less extreme, but there's still tax increases focused on the wealthy, and she says she's going to be increasing spending on healthcare, childcare, and housing. And again, the net expected impact of this on the US debt is 1.2 trillion. So still a substantial rise in debt, substantial rise in deficit, not quite at the order of the Trump policy agenda. And the risk, of course, with tax rises is that they start to be felt through a slowdown in economic growth. So one thing that leaps out from this is, deficit reduction doesn't seem to be a campaign issue at all for either candidate. The deficit's running at 6% of GDP, and that's in a time of pretty strong economic growth. The total debt burden in the US as well is running at 120% of GDP. So at some point, you question whether, how long this can continue for. I'm not expecting it to become a live issue anytime soon, but once the credibility of the US is called into question, it could be, things could start to get quite interesting. What I would say the impact of these agendas, particularly the Trump agenda, is that it's likely to lead to higher interest rates in the long term relative to the current position. Now, the reason, though, that markets are maybe not pricing this in at the moment is that there's still quite a degree of uncertainty about what's actually going to happen. So in particular, both candidates will be dependent upon the balance of power in Congress in order to implement their policy platform. At the moment, it looks like the Senate and the House of Representatives are going to be split. So you'll have Republican control of the Senate and Democrat control of the House of Representatives. That's obviously going to put a brake on either candidate trying to get through what they want. I would say that the impact of the US election has got the potential to be significant, particularly in terms of interest rates, potentially in terms of slowing economic growth if the tariffs backfire in Trump's case. But the effect of this is likely to be felt over a prolonged period as it becomes clearer exactly what each candidate is actually going to do or wants to do and is actually able to achieve. Coming a bit closer to home then, I always like to talk a bit about the gilt markets. It's a key indicator for the fortunes of DB pension schemes in the UK. And on the left-hand side here, I've got the nominal gilt curve. So that's the yield available on gilts of different maturities. And the blue line shows where this sat at the end of June 2024. And then the green line is bringing us up to last week. And to look at the changes in the yield curve, you can divide this up into two sections, really. So at the shorter end, so that's below 5 years, this is really dominated by monetary policy and market expectations of monetary policy. You can see that the green line has moved much steeper now. This has been as inflation's undershot expectations and markets have started to price in a steeper trajectory of rate cuts. It's not shown on the curve, but markets are currently pricing in an end base rate of around 3.5% from the Bank of England. And I mentioned earlier, but around between 1 and 2 cuts in 2024. That's 1 or 2 further cuts. If we're looking at the longer end of the curve then, so that's particularly above 10 years, here the curve is much less affected by monetary policy, which is obviously designed to be a short term, to affect the short term much more. So here I would expect that government fiscal policy is going to be much more of a determinant on the yield curve. And to see what's happened here, I've got this chart on the right-hand side, which is just plotting how the 20-year gilt yield has changed over time, broadly coinciding it with the general election as well. We can see that the 20-year yield is starting off around 4.7, and it originally fell down to around 4.3%, so quite a significant move before then rising back up. And this, I mean, you can never be certain of causation, but it does kind of line up quite nicely with the government narrative during this time. So in the months after the election, the government really seemed to be focusing much more on fiscal credibility, talking about the need for spending cuts. This would drive down the yield curve as markets are maybe anticipating a slight reduction in supply relative to what they'd previously expected. Around the time of the Labour conference, though, the new Chancellor seemed to be talking much more openly about the need to invest to stimulate growth in the UK, and specifically the need for the government to borrow to invest. And this coincides with this significant rise in the yield curve, potentially as markets are anticipating greater supply. There are other factors feeding into this, of course, but it does kind of illustrate the volatility we're seeing in the gilts market at the moment, and potentially how the budget could impact that. So thinking about the budget, obviously the Chancellor's talked about the importance of growth and the need to borrow to invest. There's also a big focus on balancing the book, and those things are kind of directly in contradiction with each other. The cost of public services is increasing as the population ages. So the Chancellor's got to find money from somewhere in order to fund this investment. And the 3 levers she has available to her. So firstly, you've got tax rises. Now, 75% of the tax base has already been pretty much ruled out. So that's your income tax, corporation tax, national insurance, obviously the employee portion of that, VAT. These are also the easiest bits to actually generate further revenue. Taxes that have been discussed, so you have inheritance tax, capital gains tax, pensions tax relief. These are all wealth-based taxes. And I think one of the issues here is that they can lead to significant behaviour changes. So I know that there's been quite a bit of discussion around these measures, and perhaps some of them, in particular capital gains tax, isn't going to raise the amount that the Chancellor was hoping. Fuel duty's also been put forward as an option. The one that seems to be sticking a bit more is employer national insurance. It does look like that's going to be increased in the budget next week. We do, of course, have to wait and see. Now, tax rises are part of the solution. The next bit is more borrowing, and here the Chancellor is limited by the fact that she's committed herself to following the fiscal rules of the previous government. This is kind of formed in the experience of the trusts, what would you call it, the trust budget, mini budget, where fiscal credibility was lost. So the government's been very keen to kind of take a different approach here. A range of options have been kind of discussed in terms of increasing borrowing, but it does seem that there's going to be a bit of a change in the fiscal rules. So probably the options that are most likely are that there's going to be some form of exclusion of investment from the calculation of public sector debt. So that goes into the fiscal rule of public sector debt has to be decreasing by the end of the OBR's 5-year projection. There is some support from some economists on this issue because they feel that the fiscal rule is damaging future growth prospects. Amongst them, you have the OECD. And it look kind of the central estimate for how much this could raise is about 20 to 30 billion pounds a year, which adds up to quite a significant amount if you're taking it year on year. That's also quite a significant amount to be absorbed by the gilt market as well, though. The final option as well is spending cuts, and it does seem likely that there's going to be some pretty harsh settlements with government departments. So the balancing act here is how is the government going to be able to generate growth when some of these tax rising options are likely to be acting in the opposite direction. There's also a challenge as well, which is that any additional borrowing is likely to be reflected in the cost of borrowing pretty quickly. So the yield curve will adjust to allow for future expected supply. It's going to raise the cost of borrowing for the government, but the benefits of growth are unlikely to be felt for a number of years to come. So the fiscal position is likely to get worse before it gets better. And that increase in borrowing is actually taking up a significant portion of the current budget as well. So the more that we're paying away on interest payments, the less we have to meet day-to-day spending. So just quickly then on outlook, I've mentioned that the equity market's pricing in this very kind of optimistic scenario around interest rate cuts, sustained growth, receding inflation. So in terms of things that can throw this off, I've already mentioned political risk. So that's your US election, UK budget are foremost amongst those concerns. Other areas that we're looking at which could disrupt the narrative, you have the potential for a hard landing. So that's essentially central banks keeping rates too high and tipping economies into recession. That risk does seem to be receding, but we're not completely out of the woods yet in that respect. If you're seeing equity markets repriced to factor in a recession, you could see some substantial falls, as we saw in July and August. Thinking about the equity market specifically as well, there is quite a sensitivity to future assumptions around how easy it's going to be to monetize AI investment. And will there become a point at which the tech giants are going to be overpriced? Consensus at the moment seems to be that the equity market could still run for quite a way to come, but at some point we could see that start to unwind, and the question will be, is there going to be contagion to the rest of the market, or will it be a slow, quite contained process? And then the final point that I've not mentioned at all, but it's still worth flagging, is, as we know, there's a lot of conflict in the world. In particular, the conflict in the Middle East has a lot of potential to escalate. From an investment perspective, the risk there is that starts to disrupt global supply chains and puts us back into that inflationary cycle that we saw after the Russian invasion of Ukraine. So these are the main kind of short to medium term risks that we see out there. So in terms of considerations for investors, the things that we're talking to clients about at the moment in relation to growth portfolios mainly, so we're thinking about that concentration risk that I've mentioned. The US index is it's weighted about 30% to those top 7 tech stocks, the Magnificent Seven. And as a starting point, I think it's quite important that investors understand their exposures to those stocks, because you could think that you have quite a diversified portfolio, particularly if you're in a passive global index, but you might actually find, once you look under the bonnet, that there's quite a lot of concentration in risk in there that you weren't aware of. So as a starting point, just understand that exposure. For investors who are then uncomfortable with that, diversification is kind of the key focus here. So if you've got a sizable equity portfolio, you could be looking at introducing, say, some active management. into that if you don't have it already. So that's giving managers the discretion to underweight those stocks if they feel that the narrative is turning. Obviously, whether you can successfully choose a manager who's going to do that is another question. But then for clients, particularly those who are have longer term horizons, so open pension schemes, for example, with a sizable growth allocation, we're looking at kind of diversifying away from equity into different asset classes. So in particular, we're looking at what I term as low beta approaches. So you're looking at generating returns without too much reliance on the equity market. Now, hedge funds is a classic example of this. So they would look to generate returns in a range of market environments. But also for those investors who can stand the illiquidity, we're looking at real assets, so it's things like infrastructure, natural capital, something that's going to generate you an income stream. It's likely to have some inflation linkage as well, either explicit or not indirect. So it's those asset classes. They'll also protect you should the inflation cycle return, at least over the long term. And then finally, it's something we've been talking about for many years now, but if you're a long-term investor, you can stand that volatility as long as you don't need to sell your assets and don't become a forced seller. So cash flow generation in your portfolio is really key. Fixed income is a good way to do this, and actually I've talked about interest rates potentially being higher in the long term. So actually I would imagine that the environment for fixed income investment is likely to be pretty positive going forwards, certainly not seeing any return to the ultra low interest rate and yield environment that we saw pre-2022.